Good morning, Saturday morning tea with Travis. It's January 24th, and I'm just catching up. I haven't reported the last week just because of this interesting phenomenon going on, and I'm going to talk about this now. And it basically is the question is why are mortgage rates going up? And they really shouldn't be. I mean, all the speculation and rumors here a month ago was that rates were going to get down to 4.5%, and the Feds were going to push, even crazy rumors like 3% and things. And dynamics have evolved, and it's kind of interesting how and why it's happening. So I want to explain on kind of layman terms what's going on. And probably the simplest, easiest way to explain this is to compare to oil and how oil pricing works and how it translates to the price at the pumps when you go in to fill your gas tank. So let's imagine that you have a portion of your portfolio in your 401k purchasing oil. And every day that you go online and you look and you see the price of oil, let's say it's $42 a barrel. It was $42 a barrel back on December, and now it's $42 back here now in mid-January. And you're thinking, well, gosh, it hasn't really changed. It's gone up $1 or $2, it's gone down $1 or $2, but it's basically still at $42 back when it was back in December 17th. And so you're thinking, well, great, no, whatever, it's not getting worse, so my investment is still doing well. But every day since December 17th, you've pulled into the pumps, and the gas prices have gone up. So you're thinking, well, why am I paying more when I fill up my gas tank, but I'm not earning more in my stocks? So you're thinking, this is weird. What's going on? It comes down to one simple thing: supply and demand, and that's what's happened. These lenders have been so overwhelmed with so many rate locks and new applications coming into their companies, they really haven't been able to handle this load. And so three things are going on. One, we're operating at skeleton crews because of the dismal 2008 up to September, October, even November. It just was terrible times for loan applications, mortgage rates, the economy, and so on. And so these companies, investors, banks, secondary lenders, and so on, had cut their staff down to such a small level. And so when this flood came in mid-December, when rates did get down to 4.75, they just were overwhelmed. They couldn't even process the loans that were coming in. They were just trickling through. I mean, they were getting, let's say, example, 1,000 a day, and they could do 100 a day. And then now they have the pressure of the lock expiring because they have a short-term lock because of the secondary market. They basically sell locks to us on our level to give to you, the client. And so they couldn't even process that. The second thing is some of these companies, and most of these companies, have a set-aside amount on basically a credit line. Let's say they have a $200 million credit line to fund loans to close, and then they sell them to Fannie Mae and so on. Well, if they've got locks worth $300 million, and all they have in that window of time during that lock period is $200 million, then there's no way they can service those loans. And the final thing is, just to all the losses that they've had and to hire back all the staff that they need to process these loans, they need to keep some profit right now. So three things. They can't do it. They couldn't do it. They couldn't handle the workload and be able to process them. They didn't have the money to fund all these deals, and now they're keeping some profits to recover from the losses from last year. So it's simply supply and demand. So if you look at a chart today, like a mortgage-backed security chart, when it closed yesterday and Friday afternoon, back to December 17th, we were almost exactly the same on the same parallel line of pricing for a mortgage-backed security. So that should translate and mean that we should get the same rates we had on December 17th. I locked over a dozen clients back in that week before Christmas at 4.75. But it's very frustrating for me because I have a lot of clients that wanted to do something, and I've got them engaged in wanting to refinance, but I'm looking at this chart, and it's very frustrating because it's the same price, but the investors are not sharing that with us. So a few things will happen over the next few weeks. Staff is going to be coming up. They're going to be getting this cog out of the wheel and getting loans moved through. We'll go into the new month into February. There are some pressures on treasuries right now because the Feds are printing so much money. There is a decline in pricing, but there was actually a big raise in pricing back in late December that should have even got rates down to 4.5, but it never translated because of these reasons. So I just want to update you. There is hope. As long as not much changes, there shouldn't be. The economic reports that are coming out are still dismal, and that means good news for bonds. It takes money away from stocks. As you saw, Intel laying off people, Microsoft's laying off 5,000 people. Anytime there's bad information in the stock market, that floods money into bonds. And so we should see improvement. Just hang on, and hopefully we'll get back down to the forest for you. So hopefully that was helpful to you. We look forward to serving you, and be blessed.